I'm Sarah Phillips. I'm a private client partner in our Reading office, and oh my word, what a couple of weeks. Not only did we have the budget, we of course had the US elections, and we found out that Gary Lineker is leaving Match of the Day. Doesn't get more exciting than that. Hope you're all managing to catch your breath. Now, I've got the easy job this morning in that I'm introducing today's session and introducing our 6 wonderful speakers. We've got a lot to pack in the hour, and they're going to start delving a little bit deeper into the budget announcements and what we think it means for our clients, your clients, and quite possibly for you personally. Bit of housekeeping before we kick off. That's no pun for no Gary Lineker pun there. You can submit questions during the session using the Q&A function on your screen. If you are submitting questions, we are going to try and get through all of them, but if we don't, if you include your name and email address, we'll get back to you with an answer afterwards. A recording and a copy of the slides will be available a short time, maybe not today, but a short time after the session, and we'll also be posting a feedback link, so please do give your feedback on today. So today's agenda, is packed. I'm going to let each of the 6 speakers introduce themselves, but we have Helen, we have Kat, we have Andrea, Naomi, Jess and John. And I thought before we kick off, obviously I want to thank everyone for joining, but also if you just go on a few slides, please. And again, lovely, thank you. If for those of you that don't know, Owen Mitchell, we're a national firm across the UK. This map won't be on the screen for long, but if it's glaringly obvious that you're in Nottingham and we don't have a Nottingham office, don't worry, we open one this week, so we've got you covered. So without more further ado, I'm going to kick straight off with an introduction to Helen, who's going to start today's session.
Thank you, Sarah. I'm Helen Clark. I'm a partner in the private client team based in the London office, and I'm going to talk on the changes that have been announced in relation to business property relief, which will impact individuals who hold business assets and business owners, particularly family businesses. So the Chancellor announced significant changes on budget day to the business property regime, so BPR for inheritance tax. We don't have the draft legislation yet, and the government are publishing a technical consultation in early 2025. So I'll talk through the headlines of the proposed changes, the impact that we understand that they will make, and also some practical planning points. So what we do know is that from 6 April 2026, the current rate of 100% relief from inheritance tax will no longer apply to all qualifying business assets. So it's been significantly restricted and limited to the first £1 million of eligible business property. And also this capped allowance will be shared with any property eligible for agricultural property relief. So there will only be one combined allowance, excuse me, of £1 million. And then the effective tax rate above the capped allowance will be 20%. So it's a significantly different regime going forward for business owners. The rate of business property relief available in respect of shares not listed on recognised markets, including AIM shares, will be reduced from 100% to 50%. Again, this is from 6 April 2026. And those shares won't have access to the capped amount as a deduction, so they won't have the benefit of the £1 million capped allowance. Property currently attracting BPR at 50% will continue to do so, and it won't count towards the £1 million allowance. So moving on to 1.2. We understand that the £1 million allowance broadly applies in 3 scenarios. So we have on an individual's estate at death, so any business assets that are held at death should have the benefit of the £1 million allowance. It will apply in respect of any failed gifts, so any potentially exempt transfers that fail. So if the donor dies within 7 years, the £1 million would be applied towards that. And it will also apply in respect of lifetime transfers where there is an immediate inheritance tax charge, for example, transfers into trust or into a company. Excuse me. And if an individual's £1 million allowance isn't fully used on death, it can't be transferred to a surviving spouse or civil partner, unlike with the nil rate band and residence nil rate band. So at the moment, it appears that it will be a case of use it or lose it, but we understand that representations are being made for this to be transferable. So we'll see what happens with the consultation. So moving on to 1.3. The changes to the regime also impact trusts, so trusts that hold business assets. So from 6 April 2026, a similar £1 million combined agricultural property relief and business property relief allowance will apply for trustees, limiting the first £1 million of qualifying property to 100% relief. So if we apply the rules as we understand them to be, but subject to the outcome of the consultation, there would then be a 10% entry charge to tax on qualifying business assets settled above this amount after April 2026, whereas presently assets qualifying for business property relief will be 100% relieved, meaning that there is currently no entry charge to tax, and we anticipate that those assets will then be taxed in the relevant property regime at 3% on 10-year anniversaries and with a proportionate charge on exit. Again, it's all subject to consultation and we don't have detail at this stage. Where a settlor created more than one trust before budget day, so before 30th October this year, with qualifying property, each of those trusts will have its own £1 million allowance from 6 April 2026. So those settlors and trusts are in a favourable tax position. But for a settlor creating trusts from budget day onwards, such trusts will share the capped £1 million allowance. So moving on to look at the planning considerations and the impact of the changes. So in basic terms, the £1 million capped allowance for business property relief means that transfers of assets formerly outside of the inheritance tax net are now likely to incur significant inheritance tax liabilities that hadn't been planned for. So this applies to assets passing on death as part of a succession plan and as part of lifetime succession planning and gifting. So outright gifts can be made before 6th of April 2026 while still enjoying 100% relief. However, we understand there will be anti-forestalling rules, meaning that the new capped allowance will apply to gifts made before 6th April 2026 where the donor dies within 7 years on or after 6 April 2026. So it would only be if a donor died before 6 April 2026 that unrestricted relief will be available, but at least in making timely gifts, the 7-year clock starts ticking. Spouses and civil partners should look to rebalance their business assets during their lifetimes to maximise each individual's allowance. So if each spouse or civil partner has business assets up to £1 million in their name, then they will have a combined £2 million allowance between them. And as I said, this isn't currently intended to be transferable, hence the rebalancing. We also recommend that individuals review and amend their wills to ensure that they make best possible use of the available reliefs from 6 April 2026, and we'll discuss this later on in the talk. Moving on to 1.5. As I mentioned, the IHT benefits of AIM holdings are significantly reduced from 6 April 2026, so current AIM shareholders, including trustees, should consider whether the investments still meet their objectives, and it may be that they need to consider additional estate planning measures. Lifetime transfers of business property into trust can continue to benefit from 100% relief until 6 April 2026 without an entry charge. So there is an opportunity for clients who have business assets who are concerned about asset protection to transfer those assets with the benefit of 100% relief into trust before that date without triggering the entry charge. But then from April 2026, we anticipate an entry charge of 10%. So there's potentially a window in which to do planning, but obviously it'll be necessary to consider how the decennial and exit charges would then be funded during the lifetime of the trust, which is essentially the cost of asset protection where outright gifts are not desired. Then tax due on death on qualifying business assets can be paid in equal annual instalments over 10 years. However, the real impact is going to be how the families and businesses will pay this tax. It's going to be quite a significant tax. It might impact the viability of such businesses, considering how the tax will be funded. There are concerns that there may have to be fire sales of assets. And if a company has to pay a dividend to a shareholder to pay the tax, to pay the inheritance tax on an estate, then the effective tax rate becomes quite significant. There would be dividend tax plus the inheritance tax charge, so it would be a costly exercise. It may be that the legislation will permit companies to pay the tax direct to HMRC, but at the moment we don't know, and this is the position as we understand it to be. So moving on. Planning considerations for all business owners. So it's important to review current structures to understand the impact of the changes and how they will impact. And valuations of business assets will be important when doing so. Family business owners could consider fragmentation of company shares, creating different share classes. There will be tax considerations, and it's beyond the scope of this talk, but just simply to flag that shares can be owned by different generations or trusts to give minority discounts to achieve valuation advantages and to maximise use of the £1 million allowance. And whilst an outright gift, protection or asset protection can be built into the Articles of Association and Shareholders Agreement to include transfer restrictions to maximise asset protection and to prevent dilution of shares outside of the bloodline, which is often a real concern as part of the succession plan in relation to family businesses. We would also recommend considering the use of nuptial agreements on the transfer of shares. So a donor might insist on a prenup or a post-nup before transferring shares. And a point about capital gains tax, obviously, if there are to be lifetime gifts of shares, either outright or into trust, then consider the use of business asset disposal relief for capital gains tax. The rate is still 10%. So £1 million lifetime allowance with a current rate of 10%, which is increasing to 14% in April 2025 and then up to 18% in April 2026. But there should also be holdover relief for capital gains tax, business asset holdover relief if a dry tax charge can't be funded. And then also consider the risk of death within 7 years and how to fund this. So life insurance will play a big part possibly in planning in respect of lifetime gifts, subject to affordability, and any existing cover should be reviewed and make sure it's written in trust for inheritance tax efficiency. And taper relief has survived. So any gifts should still have the benefit of taper relief, meaning that, again, timely gifts with the 7-year rule reduces taper relief will reduce any tax if death occurs within the 7 years. So moving on to 1.7. So points awaiting clarification. There are still a lot of grey areas. We don't know if the £1 million allowance will be a lifetime limit, so if it will apply similarly to business asset disposal relief for capital gains tax, or perhaps it might replenish, as does the nil rate band, every 7 years if used in planning. It's not clear. There will be the consultation, but at present the policy paper on the intended reforms doesn't confirm this. And then equally, how will the new business property regime apply to property held in trust? So with the exit and decennial charges. So I speculated earlier with regard to the 3% decennial charge and then the proportionate charge. But again, we don't have detail, particularly regarding the position of trust settled before 30th October 2024. So we will have to see what emerges after the consultation, what the outcome is, and when we have draft legislation. So there's also the question mark over whether any pre-existing trust will have its own £1 million allowance, or whether any pre-existing trusts already funded with relievable property will have their own allowance. So if the Set Law has created a number of trusts prior to budget day, but those trusts don't yet have business assets in them, might it be possible to put business assets in prior to 6 April 2026 so that each trust has the benefit of the £1 million allowance? I doubt it, but we'll see. And again, the government intends to publish the technical notes in early 2025, which will then hopefully clarify the position. So moving on to my final slide, we just have the timeline of key changes. So I won't go through them all, but it is, as we've talked about, we've got the timeline essentially from 30th October 2024 to 6th April 2026. So it's going to be key in that period to review the impact of the changes as we understand them to be, to consider any planning that can or ought to be done. And then when we have the draft legislation, to be moving forward with implementing any planning. So I will now hand over to Kat, who is going to talk about the impact of the proposed changes in respect of agricultural property relief.
Hi, thanks, Helen. I'm Kat Wayman. I'm a partner in the private client team here at Owen Mitchell, based in the Leeds office. I just thought I'd start by quickly covering the position as it stands for agricultural property relief from inheritance tax, and that is that until 6th April 2026, relief applies at either 50% or 100% to the agricultural value of agricultural land and certain character appropriate buildings, which are owned and occupied for the purposes of agriculture during the relevant period. So that is 2 years where land is occupied by a transferor and 7 years for let land. Broadly, 100% relief is applied where the land is farmed in hand, so where the owner can obtain vacant possession within 24 months, or where the land is subject to a tenancy beginning after 1st September 1995, so a farm business tenancy known as an FBT. In all other cases, the 50% rate of relief applies, and the main example of that is land let under the old AHA tenancies. There's currently no limit on the amount of relief that can apply. On the next slide, we'll look at the changes announced in the budget on 30th October. And that is, as Helen has mentioned, in relation to business property, from the 6th of April 2026, the rate of agricultural relief will remain at 100%, but only up to the value of £1 million. And where the combined value of business and agricultural property assets exceeds that £1 million threshold, the rate of relief will be reduced to 50% for all assets in excess of that value. The £1 million will be applied between business and agricultural assets proportionately, so that will be automatically apportioned between business and agricultural assets according to their value, and there's no ability to choose how the reliefs will apply to those combined assets. Unlike the nil rate band and residence nil rate band allowances, the tax-free £1 million for business and agricultural property can't be transferred between spouses, as we currently understand it. So if any of the £1 million tax-free allowance hasn't been used, so say where the whole of the estate passes to a spouse and is spouse exempt on the first death, it can't be carried over and used on the second death. It's simply lost. This might be changed, and we should know more when we have more detail early next year. In a separate change, which is some good news for my clients, from April 2025, the definition of agricultural land for agricultural property relief purposes will be extended to include land managed under environmental agreements with or on behalf of certain government and public bodies and local authorities, etc., as was expected. The changes to relief for farms and businesses will have a really big impact on farms and estates. On the next slide, I'll go through some of the planning points we're already looking at with our clients to try and mitigate the effect of all of these changes. I think it's fair to say that starting estate planning early will be even more important than ever for our clients. The most obvious and straightforward option will be looking at outright gifting to the next generation, because for now, thankfully, the 7-year period for pets remains unchanged. There's still the option to gift assets before 6th of April 2026 and before the new rules take effect, but that is, as Helen's mentioned, subject to these anti-forestalling rules, which apply the new £1 million allowance to gifts that are made before the 6th of April 2026, but where the donor dies within 7 years and on or after the 6th of April 2026. If possible, we might want to combine outright gifting with life insurance written into trust to hedge against any deaths within the 7 years or deaths of family members in the wrong order, I suppose. It also goes without saying that, as we do already, we really need to review those ownership structures, such as partnerships, trusts, companies holding relievable assets, in particular now in the context of passing value on to the next generation, and because using those structures can provide really useful ways of the client retaining some control, which is often a concern. And so it might well be that the solution involves a combination of outright gifts, insurance, and using other structures. The difficulty with gifting, however, might be capital gains tax, as outright gifts are chargeable events for capital gains tax. Holdover relief for gifts of business or agricultural property might apply, or it might be a good idea to trigger a disposal for business asset disposal relief while the lower rates of relief still apply, and obviously depending on the client's individual circumstances. I think valuations of relievable assets will be increasingly important, as will factors like creating a reduction in value through joint ownership. We're looking also at more complicated planning like reversionary leases where appropriate and where the client's got the appetite for something like that. The other important aspect we need to keep in mind is the potential effect of passing assets onto the next generation in terms of divorce and probate related disputes. As Helen said, pre and post nup agreements will need to be discussed as part of these conversations about gifting to the next generation, in order to provide some protection for those inherited assets in the event of a divorce. And likewise, care needs to be taken if we are splitting land between multiple next generation owners to skip generations or to benefit from as many allowances as possible. For example, just one of the children is working in the business, or even there's a disagreement between joint owners, this can lead to litigation, which actually might be more costly in financial and emotional terms than the tax avoided. For some clients, for certain core assets, we might look again at conditional exemption if we've previously discounted it on the basis that we have agricultural and business relief at 100%. So in just a quick summary, conditional exemption is available for significant cultural assets such as outstanding buildings and the land essential to those buildings and outstanding land, and that will be usually land in an AONB or SSI, triple SI, will usually qualify, but there might also be land that hasn't been designated under those schemes that would also qualify. In return, the landowner has to provide an undertaking to HMRC that it will maintain that land and permit reasonable public access. And it's usually that element of it which can be unattractive to clients. Exemption then remains in place until a chargeable event occurs, such as a sale or disposal or death, or the land is de-exempted, and that then triggers a recapture charge. The problem is that when conditional exemption ends, neither agricultural or business relief are available to reduce the value for the tax charge, regardless of whether they were available when the conditional exemption was awarded. The other issue that we need to watch out for is that conditional exemption might also prevent the owner putting land into an environmental or natural capital scheme where under that contract the applicant can't already be under a separate agreement to do the same thing. So we need to look quite carefully at the future of that land and plans insofar as we can, and look at all options in order to make decisions for the long term. I think under these new rules, estate planning will be more complex, and we need to start earlier than before these rule changes. And it will likely involve, I think, a combination of approaches across our teams within Owen Mitchell and also with financial advisors and accountants. I'll now pass on to Andrea Jones, who will talk about the changes to inheritance tax on pensions.
My name's Andrea Jones and I'm a partner based in Leeds at Owen Mitchell, and I've practiced in private client. I'm going to talk today about inherited pensions and provide a quick overview of the proposed plans relating to pensions which are due to come into place from 6th of April 2027. I'm going to provide a summary of how those proposed changes will impact on estates and some potential planning opportunities. At the moment, the proposal is for the majority of unused pension funds and death benefits to be included within the value of an individual's estate for IHT purposes. These are going to create a tax liability for many more individuals where there are funds remaining within the pension at date of death. Pension schemes administrators are also going to be liable for reporting and paying IHT due on pensions, and there's a technical consultation until January 2025, so it's worth engaging with that if you have any views on the impact of these proposals and any suggested amendments or difficulties that they may create. And I'm just going to go through some of the difficulties actually that I think are going to be caused by these new proposals. So just moving on to the implications for estates, this will now create a new aggregable capital sum to include in an estate for inheritance tax. So there'll be three values to consider on the death of an individual. You'll need to have a look at the value of the free estate, value of any aggregable trusts, and the value of the unused pension as well. This will create additional administration and responsibilities for personal representatives and pension scheme administrators. Some of the issues that I can foresee and some of the challenges and considerations to look at are how is it going to work where an individual has more than two pensions? There might be GDPR issues in relation to release of information between PRs and pension scheme administrators. There'll be increased due diligence to identify the information to calculate the tax. There's likely to be delays gathering information to prepare the inheritance tax account and pay the IHT. What happens if corrections are required to the inheritance tax account after 6 months? What happens if a deed of variation is effected after 12 months, but within 2 years? So that reverts to the estate to pay the tax. Does this apply to the tax on pension if pension funds have been released? So there's going to be quite a lot of responsibility for those PRs and pension scheme administrators to work together and make sure tax has been reported correctly and there's no surplus tax payable after 12 months. Similarly, what happens if a deed of appointment from will trust is effected after 12 months but within 2 years, which might affect the inheritance tax payable? PRs might be advised to delay full distribution until the expiry of 2 years to deal with any changes to the tax liability. There might be an increase in claims against estates where there's blended families. There's probably going to be a need for more insurance. It's also worth consideration of professional personal representatives to put the responsibility on them. That will obviously come with an increased cost, but it might be worth it for lay PRs to appoint corporate trustees under a power of attorney. There's likely to be liquidity issues where commercial property is held within a pension, and that might be the commercial property from which a business is operated. So thinking about how that cash is released, that there might be some impact on businesses there. There's also an impact on the residential nil rate band. I'm just going to go through an illustration on the next slide. to show the worst case scenario of how the impact of this will affect the residential no rate ban for some individuals. So from April 2027 at the moment, if a deceased is over the age of 75 at the date of death, most beneficiaries will pay at least 2 sets of tax before receiving the inherited pension. So first of all, there'll be the 40% IHT charge, and then secondly, there'll be the income tax at 45%, which is likely on most of these pensions because there will be a higher value, and that equals an effective tax rate of 67%. Just to go through this illustration, if you take a £2 million pension pot, assuming that the nil rate band has already been used and there's no exemptions or reliefs, and the deceased is over 75 at the date of death, the IHT, so first tax is the IHT will be 800,000. Second tax, you've got income tax at 540,000. And then there's the additional IHT for the loss of the residential nil rate band, where the estate is valued over £2 million. It will taper away to zero. So HMRC's policy paper actually uses an example that shows the effective rate, combined rate could be as high as 90%, which is quite staggering. So moving on to planning opportunities and things that we can think about to reduce that tax for our clients. That could be a greater case to use flexi access drawdown or annuities. I would foresee that from April 2027, the withdrawal of the 25% tax-free lump sum will be much more valuable to clients. And the use of the ability to take that tax-free lump sum out can then be used for gifting. Clients could take then a regular income and use the gifts out of income exemption. If they've got plenty of surplus income, it's a way to gift that money out of their estates tax-free. Obviously, they've got to be careful if there's anything left in the pot, because that will be taxed at death, but that's a way of reducing down that pension pot and gifting it through to the next generation. In terms of annuities, they cease on death, so there'll be no IHT on death, so they might become more attractive. As Kat's mentioned, lifetime gifting, generally really, and looking at the estate as a whole and looking at where other gifts can be made, maybe outright or into trust. The increase in use of life insurance written into trust, and it's really important that insurance is written into trust to take it outside of the estate, which would help in terms of meeting the tax liability. And there's tax liability for 3 elements for clients to think about. So it's the free estate, any failed pets, and the pension. And because of those 3 elements, it's more important than ever that pension nominations are aligned with wills and letters of wishes, and the appointment of personal representatives is really another key area to think about. Make sure that those PRs are going to understand what their role is and liaise with the pension administrators to make sure that the tax has been reported and the full estate is distributed as the client wishes. So there is more than ever, to reiterate really what Kat said, more than ever an importance of collaboration between legal, tax and financial planning advice. In terms of the surviving spouse position, it's also worth having a think about whether the old spousal bypass trust is worth setting up. So setting up discretionary trusts on first death, or prior to first death, so that on first death, any lump sum goes into that discretionary trust. So it's outside of the estate of the surviving spouse, but can be used for the surviving spouse and wider family if needed. And that will help to reduce the value of the surviving spouse's estate for inheritance tax. Also thinking about gifting to charities to benefit from the reduced rate of IHT. I think we need more detail on that, but that's something to consider. And of course, post-death planning with variations and appointments. So lots for us to consider with pensions, and as I said, I think it's something that needs to be looked at in the round in terms of looking at the free estate and all other assets held by an individual. So I'll now pass over to my colleague Naomi Neville, who's going to talk about will drafting and trusts in the context of BPR and APR assets.
Thank you, Andrea. I'm Naomi. I'm a private client partner at Owen Mitchell, based in our South Coast offices. So I'm going to talk now about how we help our clients plan for tax efficient succession in this new landscape. Many of the fundamentals of advising on will drafting remain as they were before, although, as others have said, there's likely a need now for more complex structuring advice to be provided, and that will need to be provided to a wider section of our client pool, particularly anyone who wishes to mitigate their inheritance tax liability. We still need to start in the same place we always have, which is understanding our clients, their goals, their worries, and the specific circumstances in their family that make them unique. And we can help them to understand the options available to them and guide them to find a solution which gives a level of tax efficiency on one hand that they're reasonably comfortable with, balanced against a level of complexity that's appropriate for them and their estate. And there'll be an element of personal choice in that. And they need to make an informed choice on that. As part of this, though, I think there's going to be an increased need to coordinate and work ever more closely with our clients' other professional advisors. And this will be, partly in the information gathering to get a full picture of their pension provision and to understand the availability of reliefs, but also to ensure that the plans for the estate as a whole are holistic and aligned together and capable of being implemented after death in the way the clients have intended. So setting to one side for now the opportunities clients may have in lifetime to mitigate tax, which others have touched on. When we're looking at will planning specifically, there are options for structuring to maximise tax efficiency, particularly if we're acting for a married couple or civil partners. And in the rest of this, I will talk about married couples to include civil partners, where both have access to the range of reliefs, including APR and BPR. So with a married couple, many have wanted, despite the potential tax disadvantages, to keep things simple and have relied heavily on spouse exemption to avoid tax charges on first death and allow the estate of the surviving spouse to really carry the whole of the tax liability by inheriting the entire estate. This planning would now store up a larger tax liability on the second death, as already highlighted. That APR BPR relief will only be available up to at 100% up to that £1 million restriction per person. And so because the current proposals don't allow for that £1 million to be transferred between spouses, for maximum efficiency, we need to structure the wills to make sure that clients make use of those allowances fully on the first death. This can be achieved in the will by a legacy, either outright to the next generation or into a discretionary trust on first death. Careful drafting of what actually passes under that legacy is needed to make sure we capture not only the £1 million of fully relieved assets, but also a proportion of assets which attract relief at 50% rate, and so that will then result in a chargeable transfer of up to the relevant nil rate band amount at death as well. That will then remove the maximum value possible from the survivor's estate, still leaving the survivor without facing an IHT bill on the first death. And I think something really important to mention here is that there are clients out there who will have existing wills that already leave APR and BPR assets on first death into a trust or to their descendants. But I think the drafting still needs to be checked, because not all versions of those wills will allocate partially relieved assets into the trust correctly to maximise the efficiency. If protection and long-term security is part of a client's goals, then it's likely to be much more appropriate to make a legacy into a discretionary trust. And this also allows additional flexibility for post-death planning. So for most clients, that will be the optimum option if they're comfortable with it. And moving from the APR BPR side of things and thinking more about the residence nil rate band, for a more modest estate, it is really worth thinking about drafting carefully to make sure that the residence nor rate band of the first spouse is used on first death, as otherwise we're going to be swelling the estate of the second spouse further, and that will easily result in loss of both residence nor rate band and transferable residence nor rate band if not used. Any action to maximise the use of reliefs and allowances on first death will result in a smaller pot being taxed on the death of the second spouse, and further lifetime planning by the surviving spouse is still possible at that point if they're willing to do so and able to afford to do so. What has not changed with will drafting is the need to take extra care for our clients who have previously been widowed and since remarried, because here there's still a possibility of capturing the extra nil rate band and an extra residence nil rate band if that's applicable. But what we can't do currently with this is capture a third or fourth APR or BPR allowance under the current proposals unless they become transferable. So moving now to the next slide, the pensions position and how we have to think about this as part of our clients planning for death. I think first thing, there is a lot of confusion for clients, even if we understand this, and we need to distinguish between the fact that a pension is now treated as part of the IHT estate, but that's different from the fact that it still isn't part of their estate viewed from a succession perspective, and individuals still can't control the succession of their pension pot via their wills. We've had a number of inquiries already since the budget of people saying I need to change my will to include my pension, and that continues to not necessarily be appropriate. So as Andrea has highlighted, a detailed expression of wishes document allowing a pension holder to influence the direction of decision making after their death really remains key to this efficiency here. A well-informed client should consider their will and a pension expression of wishes documents together as they plan to ensure that they meet their goals overall. There is an increased need here, I think, to consider the place of pension bypass trust, as Andrea has mentioned. And in that situation, you know, a straightforward nomination form where a pension holder nominates their spouse, or even hopefully spouse and children, without any further detail is unlikely to be satisfactory anymore, that for a client who's concerned about their IHT in the event of death. And I think it's likely that any pension bypass trust should at least be mentioned in a nomination, and I think detailed expressions of wishes are far more helpful now, and we'll need to collaborate with advisors to make sure that we're bringing into account all the things that the client might need to think about. PRs and pension scheme administrators and trustees will now need to collaborate more than ever post-death as well to ensure the accurate tax reporting. And I think this also gives rise to an increased chance of executors being consulted by pension scheme administrators after death on how they should distribute. So clients might want to include thoughts on pension distribution in a letter of wishes that goes with their will, but I still remain of the view that it's inappropriate to actually talk about pension distribution in the will itself. And as Andrea highlighted, we really need to be mindful of the impact of pension provision on the availability of residence nil rate bands for anyone with children and other lineal descendants, and ultimately will structuring for married couples to minimise the size of the estate of the second spouse is still going to be of real importance here. So finally, my final slide, a slight change of topic to talk again about lifetime trusts with BPR but also APR assets. I think we're of the view between us that lifetime giving is going to become a much bigger part of estate planning for clients who have agricultural and business assets. And as others have highlighted, the tax picture is not fully clear yet about how new trusts will be treated, but the key take-homes really are that any existing trusts created before the budget will benefit from this full £1 million allowance for APR or BPR eligible assets within them, in addition to the standard nil rate band. And I think if a client has already got assets in a trust, or possibly already has a trust they could now place relieved assets into, we need to be very, very careful with what we're advising and that clients are planning on doing with those trusts, because this protected status will be lost if assets are paid out to beneficiaries or taken out of the trust structure, and that may lead to further tax charges in future. And secondly, while we know that the £1 million allowance for lifetime giving is going to apply to all types of transfers of gifts and with APR and BPR qualifying assets, we don't know how this is going to be applied in detail. And the further consultation early next year will hopefully then result in some detail and some legislation. So please keep an eye out. We'll share the further detail as we have it. But for now, I'm going to hand over to Jess, who's going to take us through the key considerations for UK resident non-domiciliaries. Thanks, Jess.
Thanks, Naomi. I'm Jessica Fazzoni. I'm a senior associate in the private client team in our London office, and I'm going to whiz through the non-dom changes. So from the 6th of April 2025, we are no longer going to have a remittance basis for non-doms, and instead we will have a new foreign income and gains regime, the FIG regime. We will also have a temporary repatriation facility to encourage non-doms to bring in their foreign income and gains to the UK. There will also be an opportunity for rebasing of assets. And one of the other big changes for IHT purposes is that if an individual has been UK resident for 10 out of the last 20 years, they will be called long-term residents and their worldwide assets will be subject to UK IHT. So starting with the FIG regime, UK resident individuals will pay UK tax on their foreign income and capital gains unless they qualify for the FIG regime. To qualify for the FIG regime, they have to have been in their first 4 years of UK residence, and that is after 10 continuous tax years of non-UK residence, and they'll have to elect into the FIG regime. So unlike the current remittance basis, there will be no charge to elect the FIG regime, but clients really need to be careful with reviewing their residence position and ensuring that they look back and they were not UK tax resident any 1 year in the prior 10 years before picking up residence in the UK, otherwise they cannot take advantage of the FIG regime. If a client does qualify for the FIG regime, their foreign income and capital gains will not be subject to UK tax, and that's whether they bring those income and gains to the UK or leave them outside the UK. It's worth noting that the FIG regime cannot be used in relation to foreign income and gains that arose before the 6th of April 2025. The remittance rules will continue to apply there. However, for those pre-April income and gains, we can look at the temporary repatriation facility to mitigate UK tax. So clients might also want to be looking at segregating pre-April 2025 income and gains and then their post-April foreign income and gains on which the FIG regime might apply. Lastly, the FIG regime can apply to income and capital gains that settlors and beneficiaries receive from non-UK resident trusts, and that's one of the planning opportunities that they should be looking at. So moving on to the new rules in relation to transitional measures, we've got the TRF for short, the Temporary Repatriation Facility. It will be available to those currently taxed under the remittance basis. They'll be able to designate specific amounts which can be cash or non-liquid assets, and depending on the year of designation, they will pay a lower rate of tax as set out on the slide. This measure will only be available until 2027-28 tax year, and then will not be available. So non-dom clients should be looking at designating pre-6th of April unremitted foreign income and gains, and then paying the lower rate of tax next year. They don't actually need to remit the designated amount. They can then bring it in at a later date after they've paid the lower rate of tax. So this is one of the key planning points that clients need to be considering. The second transitional measure that's available is for clients who have never been UK domiciled, deemed domiciled, and have claimed the remittance basis. They'll be able to rebase assets to their market value as at the 5th of April 2017. So that's a way of mitigating or minimising their CGT exposure. Then quickly moving on to non-UK trusts. Non-UK trusts, if they're settled by a non-UK domiciled individual, there's going to be planning to consider here, and whether a settlor or beneficiaries can use the FIG regime or the TRF to minimise their UK tax. If the FIG regime does not apply, then existing anti-avoidance rules will continue to apply. So effectively, what does that mean? That means where you have a UK resident settlor who has retained an interest in a trust, they will be subject to UK tax on the income and capital gains of that trust and its underlying companies as they arise after the 6th of April 2025. Of course, this is subject to certain defences, and any tax can be reclaimed from the trust or company. UK resident beneficiaries will be taxed in the same way as they are now when distributions are made or benefits received. And one of the key points to note is that any income or capital gains that arose before the 6th of April 2025 will no longer have protected status. So it's really important for settlors and trustees to take advice and look at the planning that could be carried out around this and with the use of the TRF. So for example, if you have a settlor interested non-UK resident trust, you need to be looking at potentially excluding the settlor for income tax purposes, trying to manage trust gains, and then possibly looking at making a distribution to the settlor before April 2025, on which the settlor can claim the remittance basis, and then designating that amount in the following tax year and paying a lower rate of tax under the TRF. So that's a quick whiz of some of the planning points to be considering there around trusts. Then moving on to IHT for individuals, basically the headline news is if you are resident 10 out of the last 20 tax years, you'll be long-term resident and subject to UK IHT in relation to your worldwide assets. That's 5 years shorter than the current deemed domicile rule. And so clients who are currently between the 10 and 15 years of UK residence will now find themselves exposed to UK IHT on a worldwide basis from the 6th of April 2025. And it's important to note that if you leave the UK, you will be subject to UK IHT between 3 to 10 years, depending on how many years you've been UK resident and when you leave. IHT for trusts. Foreign trust assets will be within the scope of IHT if the settlor is a long-term resident. The time this is assessed will be when an IHT event occurs, so 10-year anniversary. Trusts will now move in and out of IHT depending on the settlor's residence position. So this is a really important point. I've had some clients who are settlers of non-UK trusts and have said that they will leave the UK before the 10-year anniversary for the trust, but that's not going to help them because when they then become non-long-term resident, so they're outside of the IHT net, that will trigger an exit charge at a maximum rate of 6% on the trust assets. So settlors and trustees really need to be taking advice in relation to the IHT exposure and just monitoring effectively a settlor's residence, UK residence position. Where a settlor has died before the 6th of April 2025 and they were non-UK domiciled, the current rules will continue to apply, so any foreign assets will be outside of the IHT net. And lastly, just to mention, the where settlor is able to benefit from the trust assets, the gift with reservation of benefit rules will not apply if the foreign assets were held in the trust before the date of the budget, so before 30th of October 2024. Anything settled thereafter and the settlor can benefit from will continue to be within the settlor's estate for IHT purposes, and we want to be avoiding that. And that is a quick summary of all the changes and some of the planning points, and I will pass on to John Bunker to cover SDLT.
Thanks very much, Jess. It's good to be with you. Very briefly here before we get on to the Q&A, and if you have any questions, do please put them into the Q&A box because we'd be pleased to try and answer your questions. Just very quickly, just to touch on a couple of SDLT points, just to flag these up. one of the changes made with effect from budget day, or actually with effect from completions the day after budget day, was the increase in the charge you pay where you've got a second dwelling, the what we call the higher rates for additional dwellings charge for SDLT. And that was 3%, it's gone up now to 5%. So the big thing there is, if you are involved with anybody who is putting money into a property, who's one of the purchasers, you might say, of the property, to try and ensure that that person doesn't get an equitable interest if they have another property interest, another residential property interest, because however sort of relatively small in terms of the value of the property, they can end up with 5% of the purchase price being payable as an additional SDLT charge. So there's a lot of scope for planning there, but I think one of the key things is if somebody's putting money in, like a member of the family, can they cover that by a loan which is secured by some kind of charge or second charge? And I think that's the that's really worth exploring. Secondly, don't forget the temporary holiday, which was due to expire in March next year, which had increased the starting point for SDLT and had increased the amount you could put into first-time buyers relief. That is going ahead as planned. So that was a Tory plan that Labour are continuing. So that, we will revert to the normal lower figures, as I say at the bottom of this slide, from the 1st of April. So if you need to get anything through before that, you need to get it completed by the 31st of March. So there isn't a lot of time to get on with any conveyancing transaction if you need to get that completed. So that's just all to say very quickly on SDLT. Now we can come to some questions. And I wonder if we might start, Jess, with one of the questions submitted in advance with regard to non-doms, and if you might pick up one of those questions, Jess. We're all going to be on the screen now, so you can see all our speakers. But Jess, would you like to take one of those questions and then give us a quick answer, quick comment?
Yeah, so one of the questions was effectively if somebody who is deemed domiciled has left the UK, they've lost their status as deemed domiciled, will they be caught back in, or how could they be caught back in by the new IHT rules? So very broadly, if they're currently already outside the UK IHT net, then the new rules don't apply to the extent they're not planning to sort of return to the UK. The new rules would effectively apply if they decide to come back to the UK. Individuals who haven't yet left and are planning to still leave, if a client leaves before April 2025, then they'll have a sort of 3-year IHT tail when they leave the UK. So they'll leave the UK just before 6th of April 2025. They'll be subject to IHT for another 3 years after leaving the UK. One of the differences is currently, if you've got somebody who's deemed domiciled, they've already been here for 15 years, they leave now, they'll be subject to a 3-year tail. If they leave after the 6th of April 2025, they'll be subject to a 5-year tail. So this is where the difference, where there is a difference. So after 6th of April 2025, if clients are leaving, their tail can go all the way up to 10 years. So that's just something to point out there.
Thank you. Great. One of the questions that has been asked by a couple of people is, I think we've answered it, but just to emphasise that, is the £1 million agricultural business threshold per person? If one of you could just emphasise that very briefly.
I can take that. Yes, per person, and currently not transferable.
And I think that that not transferable is a huge planning issue. Great. Next question. Kat, would you like to comment on the possibility of inherited farmland and sale of part for development, the CGT position?
Yeah, so just to say on that one, the old rules for inheritance tax will apply on death until April 26, and then the £1 million limit at 100% will apply thereafter. We've still got the capital gains tax uplift on death for now. So any capital gains tax on a sale for development would only be on the gain since the death. And depending on the circumstances on that, that client might be able to take advantage of business asset disposal relief to reduce that rate of capital gains tax.
Thanks, Kat. Andrea, would you see pensions moving into trust to avoid IHT? I think we've touched on that, but do you want to say just a brief further word on that?
Yeah, thanks, John. I think the use of the what's commonly known as the spousal bypass trusts, I think, is going to be more prevalent. So that's setting up a discretionary trust during lifetime and nominating that any lump sum is payable into that trust on usually on the first death of the first spouse, so that you get that out of the estate. But it's there as a fund. It's also quite flexible for blended families as well. So I think that's probably the key trust point with pensions.
Thank you. And Jess, can I come back to, there were a couple more questions in advance about non-doms. Would you like to pick up one more of those just quickly?
Yeah, one of the questions was, are we seeing effectively non-doms leaving the UK? And yes, some have left, some are planning to still leave, but not all non-doms will be leaving. It really sort of depends on family ties, and so a lot of what we're doing is actually looking at planning and what are their options, how do we mitigate any tax from the 6th of April 2025. So not everyone is leaving, so it's not a complete disaster for everyone. Thanks, John.
Thank you. Okay, and we've got a couple of other questions. One of which is about gifting AIM stocks now. Is it worth gifting AIM stocks now ahead of April 2026? Anyone like to pick that up?
I can comment on that. So basically, it will be good to start the 7-year clock ticking, but if death occurs after 6 April 2026, then it will be a taxable pet in the estate of the donor. 100% relief only applies until 6 April 2026, but accelerating planning where possible might be sensible.
And is it worth just also saying that if there's somebody with a short life expectancy who might die before 6th of April 2026, actually, if the new charges only apply for deaths after that date, so if somebody actually dies before that, there will not be, you'll have the 100% relief. So on APR and BPR, there's no £1 million limit before if you die before then. So there's actually sorry, it's a slightly different point, but it's worth just being aware of that if you've got somebody who's got a short life expectancy, that there is potential to do some planning with a trust or with a gift before April 2026. Anything else anybody'd like to pick up on the questions? We are just over 4 minutes past 10, so we ought to bring this to a close. But there's time for one more question if anyone would like to pick one up. Just looking at what we've got.
Do you want me to pick up the one, the pension one, John? So,
thank you.
Does a pension inherited or transferred tax-free from a parent who died before age 75 remain tax-free, or does it now become subject to IHT? So if there is a remaining pot in the pension at date of death, it doesn't matter about the age at which the person died for inheritance tax. So based on the proposals, it will come under the IHT net. The age 75 point relates to income tax. So if the person dies after 75, then the pot is taxed to income tax based on the beneficiary's marginal rate, and The reason why in my example I said it would be 45% is most of the time the pot will be quite large, so it will push the pot into the higher rate of tax. But below 75, based on the current rules, there shouldn't be any, and the current proposals, there shouldn't be any income tax.
Thank you, Andrea. Okay, it's 10:05, so that's probably our scheduled finish time. So that probably ought to wind the Q&A up. So back to Sarah.
Thank you very much, John, and thank you to all our speakers, and thank you to our attendees today. There have been various themes. I think one of them is absolutely, even where we don't know the exact detail yet, advanced planning. It's always been important, but it's going to be even more important. And even if we don't know exactly what that planning may look like, those advanced conversations. And the collaboration with the legal, the tax and the financial advisors are really going to be what our clients need. If we didn't get round to your questions, or if any submitted afterwards, we will get back to you after the session. Just to remind you, the feedback form is there. Do please complete it. On screen, there's a little shout out to the best IHT planning manual around. There's a new edition out next year. And I think that's all that I have. And a reminder, with any planning, I've mentioned the legal tax and the financial advice, and within the legal sphere, bringing together all the disciplines to make sure that whatever planning our clients need is looked at, whether it's from a private client perspective, a family perspective, a property perspective, corporate, what have you. We need to all be working together to do best for our clients, and I'm sure you'll all agree. So thank you again for attending. Thank you to our speakers. I shall leave you to get on with your Wednesdays. Good morning.